Hey there, Mike Wise with CMG Home Loans and your weekly mortgage update. So, normally March, it is a high season for moving, but transaction volumes, home prices, growth, and competition have all slowed or have been cooler than the previous spring market than what we have. And I think mortgage rates as well as the economic uncertainty have been a big factor in what's going on with the home sales. So let's take a look and see what does that mean for what is the news that's come out to show all that. So Case-Shiller is the gold standard for measuring values of houses, and I'm not going to spend a lot of time on this, but the index went up month over month 0.8% for the national data, okay? But the seasonally adjusted, this is again seasonally adjusted for this time of year, it went down 0.3%. That's the first decline since January of 2023, so 2.5 years ago. And basically price growth has been slowing, resulting in year-over-year growth dropping to 3.4%. What do I mean by this? I'm out there in the field, I'm talking to real estate agents, I'm seeing, depending on the market area, I'm seeing a lot of price improvements. That means prices are dropping. I'm seeing inventories go up. I'm seeing a lot of open houses out there for longer periods of time. I'm hearing real estate agents saying that there are not very many people coming to the open houses. So a lot of interesting things are going on out there, and at the same time, if your house is priced properly, you're going to have multiple offers. So I have a house that I heard an agent say yesterday, just in the valley right here next to me, basically 15 offers on it. So, and that was at a $900,000 purchase price. At the end of the day, we are being very creative in putting deals together. Over the last 30 days, we've put a lot of deals together and have seen some of these offers get accepted with a lot of seller contributions towards getting these deals done. So a really, really interesting time. Tariffs this week. Basically, Trump agreed to delay the EU tariffs until July 9th, so that gives them some time to put some stuff together. And yet, as of this morning, the talks with China have been stalled, and so there's kind of some negative news on the market regarding China and the tariffs there, and so there's some things to look at there. Pending home sales dropped 6.3% month over month, and I'm not going to go into all of this here, but I do want to talk about down here the FOMC meetings, the Fed meetings and the Fed funds rate. So we're talking about 98% probability in the June meeting that they're going to remain at 4.25% to 4.5%. So no change in June. There's a 78% probability that they're going to stay the same in July. So at the July 30th meeting. And then in September, that's where we're starting to see a 48% probability that they're going to be 0.25% lower. So that's where we think that the Fed is going to start to lower interest rates on the Fed funds rates. That does not necessarily mean that mortgage rates are going to go down, but they have this week. Last week we were at over 7%, and now this week we've come down to 6.89%. So there is some softness in the mortgage market here for the interest rates. Now, a couple of things. GDP. I'm not going to spend a lot of time on this either. But basically, the GDP. They did a revised version of the first quarter, and the first quarter was down 0.3%. They revised it up a little bit to negative 0.2%. But at the end of the day, the personal spending right here, this piece of it, personal spending was at 1.8%. They revised that down to 1.2%. What does that mean? That means you as the consumer you're spending less dollars. When you're spending less dollars, that is a sign of pricing weakness, which means lower inflation. So that means that the inflation numbers are going to go down. Again, I'm not going to spend a lot of time on this, but it is something that you should be looking at here. I'm going to come back to that in just a second. The PCE, personal consumption expenditure, that came in today, and that was very, very muted. There was not much inflation out there, so we are seeing the inflation coming down. We'll see what happens with the tariff and all that impact, because that's going to be probably in the next reports that we see for inflation at that point in time. But at this point in time, we are seeing inflation basically is coming down, and we're not having any impact there. A couple of things I want to go over with interest rates that I wanted to show you. So I want you to focus right down here in this level, right? So this is the unemployment rate. You can see this is where we've been, and the gray area is where Fannie Mae, the Mortgage Bankers Association, actually thinks we're going on with these numbers. Actually, it's Fannie Mae, sorry. So that's the forecast. Couple of notes here. So look at the Fed funds rate, right, is right in here. So 2025, they predict it's going to get down to 3.9%. That's very interesting, because that's where Scott Bessent wants to get the Fed funds rate to. But I want you to see that it keeps on going down here, this Fed funds rate. That is very interesting, because the yield still is not dropping as much. In fact, it goes up in 2026. So I find that very weird to kind of see the Fed funds rate getting better, but the yield on the 10-year Treasury was staying higher. So at the end of the day, that's some interesting news there. I do want to show you the housing forecast on this, and what I want to point out here is a couple of things, and we'll look at it right in here, the rates. Okay, so this is 2025, 2026. We're right here, the 6.8 right now, and they predict by the end of the year that we're going to get down to 6.1% on a 30-year fixed rate mortgage. They do think that over the next year that we will see some improvements down into the 5s. So I do think that the new normal is probably going to be plus or minus 6%, right at the that 6% level, which I don't think is a bad number, and I think that will keep the market going. But a couple of things here. As far as the number of units and volume, you can check this out here and see where the numbers are projected here. But I don't think there's going to be any huge increases or decreases. It looks pretty much the same as the last year or so. So at the end of the day, we'll go back here to mortgage rates. As of right now, the Treasury market is flat from yesterday, and the yield is down 0.1 or down 1 basis point. So we're not seeing much movement here, but you can see this is the prices on the Treasuries. They actually have gotten a little bit better over the this last week here. So the prices, higher prices, are better for mortgage rates. You see the mortgage rates come down. So you see this kind of brown line here. This is the 25-day moving average, and you have the 100-day moving average is right here. So we're kind of right up against that level, and we've hit those levels right there, but we haven't seen them break through. So we're kind of hitting that ceiling of the pricing. And in order to kind of get better rates, we have to see that break through and go up here. So we'll see what happens over the next couple of days here. Let's take a quick look at the yield and where that's at. Sorry, I just messed up there. So let's look at the 3 months, and we'll come back down here. So you can see again here the yield has come down, and we're hitting the 100-day moving average and the 25-day moving average. So we're bumping up against those levels there, or down against the floor of it going through. So if we do see it, this is a really hard floor, because you've got 3 different levels right here to get through. So I do think that kind of will stay here for a little while. I don't see interest rates improving very much after that. So at the end of the day, it's been a good week for interest rates. They've come down a little bit. So we'll see what happens over the next week, but hope you have a great weekend. I will be around, available for any phone calls or texts or emails over the weekend. Look forward to seeing you next week.